The U.S. tax code is 70,000 pages long. You know how many of those pages are about making sure you pay more? Zero. The entire thing, every section, every clause, every footnote was written to define what you owe, not a dollar more. But here's what nobody talks about. Buried inside those 70,000 pages are completely legal strategies that reduce what you owe significantly that the average American never uses, not because they're complicated, not because they require expensive accountants or six-figure incomes, because nobody taught them to us. We learned to earn money. We learned to spend money. We learned to save money. Nobody sat us down and said, here's how to legally keep more of what you already make. That changes today. Before we get into these, one thing worth saying clearly. Everything in this video is completely legal. These aren't loopholes in the shady sense. They're not gray areas. They're not strategies that flag your return or put you in a difficult conversation with the IRS. They're provisions that exist inside the tax code specifically for regular people, salaried workers, freelancers, parents, investors, that most people simply don't know to use. I've left money on the table with every single one of these at some point. Most people have. The IRS doesn't remind you about them. Your employer doesn't explain them. They just sit there, year after year, while most people overpay without ever realizing it. 7 moves. Let's go. Most people know a 401k exists. Far fewer understand what it actually does to their taxes today, not decades from now when they retire. Right now, this year. Here's how it works. Every dollar you contribute to a traditional 401k comes directly off your taxable income, not a deduction you apply later, off the top, before the IRS calculates what you owe. If you earn $65,000 and contribute $6,000, the IRS taxes you on $59,000. That one move saves you between $660 and $1,320 in taxes this year alone, depending on your bracket, every single year you contribute. The 2026 limit is $24,500. The average American contributes a fraction of that, usually just enough to capture the employer match and nothing more. That gap between what people contribute and what they could contribute is quietly one of the most expensive missed opportunities in personal finance. You're not just building a retirement account, you're legally reducing what you hand to the IRS every year, starting immediately. If you have a health insurance plan and you're not using an HSA, this might be the most important move in this video. And here's something worth knowing right up front. Starting in 2026, the IRS expanded HSA eligibility to include ACA Marketplace Bronze and catastrophic plans. That means millions of Americans who couldn't use this account before now can. So what makes an HSA worth stopping everything for? It's the only account in existence that gives you 3 separate tax advantages at the same time. Contributions are tax-deductible. The money grows completely tax-free. Withdrawals for qualified medical expenses are tax-free. No other account does all 3 simultaneously. Not your 401k, not your Roth IRA. Nothing else in the tax code comes close. In 2026, you can contribute $4,400 as an individual or $8,750 as a family. That full amount comes off your taxable income immediately. But here's what almost nobody knows. At age 65, an HSA converts into something functionally identical to a traditional IRA. You can withdraw for any reason, medical or not, and simply pay ordinary income tax, no penalty, no restriction. So what you're actually building isn't just a healthcare fund. It's a triple tax-advantaged account that becomes a retirement account at 65, that most people walking past it every year don't even realize exists. If you're paying student loans, and tens of millions of Americans are, there's a deduction sitting right there that requires almost no effort to claim. You can deduct up to $2,500 in student loan interest per year directly from your taxable income. Here's the detail most people miss. This is an above-the-line deduction. You don't need to itemize to claim it. Most people take the standard deduction, and they should. But this deduction sits on top of it. You get both. Your loan servicer sends you a Form 1098-E at the end of the year showing exactly how much interest you paid. That number, up to $2,500, comes straight off your taxable income before your bill is calculated. In the 22% bracket, that's up to $550 back in your pocket. Every year, for as long as you're making payments. Tens of millions of Americans are paying student loans right now. A significant portion of them have never claimed this deduction, not because they're ineligible, because nobody told them it was there. A freelancer working from a dedicated room in a 900-square-foot apartment can legally deduct thousands of dollars in home costs every year. Rent, utilities, internet, all proportional, all legitimate, all sitting there unclaimed by most people who qualify. This deduction has more confusion and fear around it than almost anything else in the tax code. Most people who qualify don't claim it because they're not sure they're allowed to. Let's clear that up permanently. If you're self-employed, a freelancer, a contractor, or run any kind of side business, and you use a dedicated space in your home regularly and exclusively for work, you qualify. The IRS's simplified method gives you $5 per square foot of your home office, up to 300 square feet. That's up to $1,500 deducted directly from your self-employment income with minimal calculation required. If you want to go further, you can deduct a proportional share of rent or mortgage interest, utilities, and internet based on what percentage of your home is used for work. A 200-square-foot office in a 1,000-square-foot apartment means 20% of those costs become legitimate business deductions. The one firm requirement: the space must be used regularly and exclusively for business. A kitchen table where you sometimes work doesn't qualify. A dedicated room or clearly defined workspace that serves no other purpose does. This deduction is real, it's legitimate, it's available to an enormous number of Americans. Most of them leave it unclaimed every single year. This one reframes something most investors dread. When your investments lose value, most people watch their portfolio fall and feel helpless. There's nothing to do but wait. That's not entirely true. Tax loss harvesting is this. When investments in your taxable brokerage account drop in value, you can sell them, lock in that loss on paper, and use it to directly offset gains elsewhere in your portfolio. Made $8,000 on one investment this year, but lost $5,000 on another. You pay capital gains tax on $3,000, not $8,000. You just reduced your taxable investment income by $5,000 with one strategic decision. And if your losses exceed your gains, you can deduct up to $3,000 of the remaining loss directly against your ordinary income. Anything beyond that carries forward to reduce your tax bill in future years. Here's what makes this genuinely powerful. The market drops every few years. It always has. The investor who understands this move looks at a down market and sees an opportunity. strategically reduce the tax bill, immediately reinvest in a similar fund to stay in the market, and turn a bad year into a tax asset, the loss stops being purely bad news. It becomes a resource. This is genuinely one of the most underused credits in the entire tax code, and the people who miss it most are exactly the people it was designed to help. If you contribute to a retirement account, a 401k, IRA, or similar, and your income falls below certain thresholds, you may qualify for the SAVER'S credit. In 2026, the income limits are $40,250 for single filers and $80,500 for married couples filing jointly. The credit is worth between 10% and 50% of your retirement contributions, up to $1,000 for individuals or $2,000 for couples. Now, the distinction that makes this matter: a deduction reduces your taxable income. A credit reduces your actual tax bill, dollar for dollar, directly. An $800 SAVER'S credit means you owe $800 less to the IRS, not a percentage of $800, the full amount gone from your bill. Most people in the qualifying income range who contribute to retirement accounts have never heard of this credit. They're already doing the right thing, saving for retirement, and they're leaving a direct tax reduction unclaimed on top of it. One more thing worth knowing: this credit gets replaced by a new system in 2027 called the SAVER'S Match, where instead of a tax credit, the government deposits a matching contribution directly into your retirement account. The rules are changing, which means right now, in 2026, is the last year the SAVER'S credit works exactly this way. That's not a scare tactic, it's just useful information. If you give to charity, this move changes the entire tax math of your giving. Most people donate cash directly, which is generous, but it's also the least tax-efficient way to give. Here's a smarter version: a donor-advised fund, available through Fidelity, Schwab, Vanguard, and others with no minimum to open, lets you contribute money or appreciated investments into a fund, take the full tax deduction immediately, and distribute to your chosen charities over time at your own pace. The first advantage: if you donate appreciated stock that's doubled in value, you avoid capital gains tax on that appreciation entirely, and you still receive the full fair market value as your deduction. You give more, the charity receives more, you pay less tax. But here's the strategy that makes this truly powerful. Instead of giving $3,000 a year for 5 years, you contribute $15,000 in a single year into the fund. That large single contribution pushes you above the standard deduction threshold, so you itemize that year and capture the full deduction. Then you distribute $3,000 annually to your charities over the next 5 years exactly as planned. Same total giving, same causes, dramatically better tax outcome. This is exactly what high-income earners do with charitable giving every year. There's no income requirement to do it. It's available to anyone who gives regularly. Most people simply don't know it's an option. Here's what these 7 moves share. None of them require you to earn more. None require you to spend less. None are aggressive, risky, or complicated. They require one thing: knowing they exist. The tax code isn't written against you, it's written around you. There are provisions inside it built specifically for regular people that sit unclaimed year after year because the system doesn't advertise them. The people who use these moves aren't smarter than you, they just heard about them first. Your employer doesn't explain them, the IRS doesn't remind you. Most people file the same return they filed 5 years ago and quietly overpay without ever knowing it. That's not a failure, it's a gap. And gaps close the moment you have the right information. Here's the thing about taxes that nobody really says out loud. Every dollar you overpay isn't lost to bad luck or a complicated system you couldn't navigate. It's a dollar you earned, that you kept, that you handed back, not because you had to, but because you didn't know you didn't have to. Multiply that by 10 years. Multiply it by a career. The difference between someone who uses these moves consistently and someone who doesn't isn't income, it isn't a better accountant, it isn't an advantage available only to people who already have money. It's just information. You have it now. The next return you file, that's where it starts to matter.